there's a big correlation here, right? There's a correlation to marketing spend, right? And deal flow. So you can't be a disconnect there. But if you're willing to spend on marketing, you can bank on about a 1% response rate.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Travis King. He's the founder of Land Investing Mastery. He's flipped land in 29 different states and hundreds of personal flips with his wife, Becca. Hundreds of joint ventures. He's done over 1,000. I think he mentioned over 1,300 one-on-one personal coaching calls. He leads a mastermind, well over 7 figures from land investing. He's the author of The Land Investor's Playbook, which you'll hear us mention through the show a number of times. But Travis has really become the expert or the go-to in this space. And he is scaling, and it's interesting to see that growth. Where it's always it seems to be. And as you listen to the show, it's the capital question, right? Of where does capital come from as we grow, and it's neat to hear that even in his business as he has scaled, and now partnering with investors as well to buy larger tracts and do bigger deals. And same thing happens in our multifamily space as well, right? It's always the capital and partnering with investors and doing right by investors. You're going to hear us talk about that a little bit, but really educating passive investors today on what is land flipping, what should you be looking for, as you are partnering with, say, an operator like Travis in this space, some things about how they're reaching out, how they're finding the deals, the things that you want that operator to be doing. You're going to hear about software he's using and in ways that he's gathering information that most are probably not doing. You're going to learn a lot from Travis today. Well, I'm excited about this guest today. Numerous people have said we should meet, and so I'm honored to have him on just so we can do just that. Very successful in real estate investing and in a niche that I feel like is growing, and he's really led the way in so many ways. Travis, welcome to the show.
Hey, Whitney, thanks for having me. Same thing. Your name kept popping up, and people kept emailing me and saying we need to connect. So I'm glad to meet and glad to be on here.
Yeah, no, honored to meet you, Travis, and I know you're going to add a ton of value to the listeners today, and they are all anxious to invest in real estate or buy real estate in one way or another, or learn how to operate it better, and so you have done just that in many ways. Before we jump in, why don't you? There's a number of aspects about your business I'd love to dive into and to talk about to help the listeners today. Your major focus is land investing, right? I love land personally, but I definitely have not owned as much as you have or bought near as much. Give the listeners a little breakdown on what that means exactly. As far as land investing, flipping, we've heard different terminology, but what does that look like, that process at a high level? And then we're going to dive into a few things.
Absolutely. Well, I start out saying I'm a land fanatic. I love to evangelize land. I don't give people too hard a time about, that land's better than houses or land's better than multifamily or something like that. I generally believe that like land plus another asset class, right, is incredible. Land is unique in that it if you understand how to work it right, it can spit off a lot of cash. And then you can take that cash and you can put it into these other assets like multifamily or single family or you know what I mean? Pick your kind of like generational wealth, stick and brick, or brick and mortar asset, right? So I'm a big fan of land because it cash flows more than any other asset class that I've worked with. As far as land flipping, land investing, generally people get started with a single parcel, quick flips, just trying to buy off market, capture some equity, and then quickly realize that gain and resell for near full market value. And that's kind of the traditional flipper. But along the way of most people that get into land flipping or lot flipping, you identify these opportunities like there might be a larger acreage property that has subdivide potential. And that's where I feel like you eventually, hopefully, and that's what our path was, you kind of evolve, from flipper to, land flipper to land investor. And you start doing things like, subdividing properties. You start kind of almost becoming a lender where you sell these properties with seller financing, right? And then it becomes almost like you're in finance and banking, not just land, right? So that's kind of, I think, the evolution of the flipper and the investor. There's opportunity for people outside their job to essentially build kind of like a 6-figure second income, like flipping. single parcels. But I think inevitably after a couple of years in the business, you start to recognize that this is an inefficient market, even at a higher level. And you can buy these larger parcels and subdivide them and kind of make that transition into land investor. When I say investor, I'm kind of speaking like as an active, active investor and operator, starting your own, you know, land flipping, land investing business.
Okay, awesome. So, what would be the difference if I was just flipping land then?
Yeah, it's generally your so kind of hold times, right? So velocity flipping, a lot of people like to flip in 6 months or less, sometimes 12 months or less, but generally a flipper is looking at like markets where days on market is 180 or less, and you're trying to cycle your money twice a year, as a flipper. I feel like land investor for us might be we subdivide, a larger acreage parcel and we sell off some children parcels and then we hold one. So you know what I mean? When we start like holding properties, we kind of move to, longer term and being investors.
Yeah.
So I'm kind of the hybrid, of both. We need to flip to bring that cash back into the business, but we also want to hold some properties so that we're building wealth, along the way, not just paying the bills.
Yeah. Well, while we're kind of at a high level talking about land flipping, investing here, speak to the types of land. Maybe some different types of land that somebody might buy as they're in this type of business, and maybe the size, just to get some context on what kind of land. What paint a little picture for us visually.
Yeah, it's a great question, and some people will really niche down to one type, and I'm not a fan of that because I feel like as markets change, as economies change, you're all in on one thing. For an example, would be let's say you're only flipping 1 acre or less infill lots in urban and suburban areas, right? Where the end buyer is going to build a house. Construction and house building is hinged on interest rates, right? So here's a good example. There's a number of people that's all they were doing was flipping infill lots. And then when interest rates had a big hike, about a year and a half ago or so, almost 2 years now, I guess, when interest rates had a big hike, you know, there was no builder. Builders were pumping the brakes. So the people that were buying the property to build a spec home or the end buyer that was going to get a construction loan, that kind of dried up. So for us, the two types that we focus on are residential infill lots that are generally like 1 acre or less, and then rural vacant land, which is much larger, usually 5 to 40 acres or even 5 to 80 acres. And rural vacant land is kind of this, I look at it like this garden, Whitney, that always feeds you, right? The infill lots can kind of be like, hunting, right? But you never know what you're going to get when you go out there, right? It's all cash sales and it's all cyclical and dependent on the interest rates in the market. Whereas rural vacant land kind of just always sells well as long as you're willing to offer terms or seller financing. You kind of always have a buyer pool. So rural vacant land and residential lots in urban or suburban areas are kind of like our two product types.
Who's the typical seller of those types of properties? If you're, so you say residential, but this may be, there's a subdivision, but there's a few lots that haven't sold or haven't been built on yet type of thing, or, who's the seller typically?
Yeah, it's kind of a couple different avatars. So when we're talking about like those infill buildable lots, quite often it might be like the aging builder, right? Who's in his 70s or 80s and he's done really well, but he's still got like 2 lots left that he never built on. And he'll tell you like, hey, I don't have the energy, you know what I mean, to do another one of these, right? And lumber and rates are too high right now. Like, like these are just like my leftover lots, right? And he probably holds them in an LLC. That's kind of like the especially we do a lot like in Florida. That's generally the case if we find a vacant lot along the lake. It's usually like some, aging builder, right, who was doing spec homes, decades ago and didn't get around to building on this one. The rural vacant land is generally somebody who has either bought it for recreational purposes or they intended to maybe build a cabin and they just never got around to it, never did it. So it's almost always both the common denominator, it's almost always just being underutilized, right? It's being underutilized and we also find that, length of ownership. The majority of our sellers have owned the land 15, 10 or 15 or even 20 years or more. So they're kind of in a situation where the land's still vacant, it's unimproved. They haven't done whatever it is they originally intended to do with it. And all they've done is pay property taxes for decades, and they're now willing to, consider an offer that's below market value, because they're just not using it in the manner they thought. But it's usually two different kind of avatars. That rural vacant land is generally the people that wanted to build the cabin, never got to it. And the other one's usually kind of the builder or second home person who never got around to doing that either.
Yeah, yeah. I want to dive in a little bit more here, and as far as I would imagine, a number of the listeners have probably heard of land flipping in some way at this point. And I know one question I know that I even have personally is just like, how do you feel? To be in the land investing space, you're going to be successful, say over the next 2 to 5 years. Like, what do you see? How do you see it changing? Because and one part of this too is that I feel like a lot of people have got into this niche. And the listeners wouldn't know this, but we've done a little land investing ourselves, and I feel like as we have sent a letter out or two, it's like, man, these people seem like they're getting 6 letters at times, right? Yep. At the same time from a lot of people trying to buy their land. But just wondered, what does that look like for you? How do you see this changing over the next 2 to 5 years? As a lot of people have gotten in this space.
Yeah, and what we saw, as not just an investor, but as like a coach and educator, as I was training people, we kind of saw through the pandemic, like a lot of the house wholesalers that were doing pretty well, buying distressed houses. I coached guys that were doing 30, 40 deals a year, wholesaling houses, and they did one maybe in the last 9 months, and because the pandemic shot up home values. And it kind of felt like there was no such thing as a distressed house, right? Like everything you listed would sell. So the combination of that, and then you have what we call these iBuyers, like when Zillow got into buying houses, Open Door, OfferPad, We Buy Ugly Houses, like all of these companies got into this, and they have like, essentially like unlimited, it feels like unlimited marketing budgets in comparison to yours. Who can send out more postcards or letters, right? Open Door, OfferPad, and Zillow, or me. So a lot of the house wholesalers and house investors kind of felt squeezed out. And what we felt was they kind of migrated over to land, right? And we're kind of like, we kind of see that movement or migration, which, we've been quietly enjoying what I consider kind of the holy grail, right, of cash flow over here for a decade. And just in the last 2 or 3 years, Whitney, is really when we've seen more interest. Land similar like to mobile homes, where there's just a lot of people that either it's misunderstood and there's like a stigma, or they just kind of turn their nose up at it, right? But we've seen a lot of interest in the last couple of years. And certainly it's no longer, I'd say, like the best kept secret, right? But what we've found is the majority of the saturation is at lower price points, meaning that generally people don't have the capital to go out there and target, $300,000 waterfront lots, even if they can buy them for 200. Most people aren't liquid enough to do that. So generally what we find is the majority of the industry and the majority of the competition is really in that, like let's say, 40 or $50,000 or less property type. So it's not that you won't run into competition. It's just that that's really red ocean when you get into that like 40,000 or less, because it's a price point where agents, there's not enough commission in it. The agents don't want the listing. The land feels like more of a liability than an asset to the property owner. So honestly, the higher value you go up, the less competition there is. And then the new problem just becomes, okay, where does the capital come to take down that deal? But the beauty is there's opportunity at every level. There's guys all day long that are, buying $1.5 million ranches for 900,000, you know what I mean? And subdividing them up and selling them for, off as ranchettes, right? So you can always buy for under market value. And the higher values you target, the less competition there is. But you also have to offer a higher percentage. You know what I mean? Meaning if we're buying a $40,000 property, we might be able to get it for 35% of its market value. But if we're buying a $400,000 property, we're probably going to be paying 60%, right?
That's good to think about. Yeah, and that's what I would expect, but it's
Saturation, what I say is kind of like there's there's a lot of side hustlers and amateurs kind of playing in the minor leagues, but like as far as professional land investors, it's not as crowded as you would think.
Yeah. And while we're talking about like the land and larger tracts of land and it really eliminating competition, it makes complete sense. Same way in our business. I mean, in buying apartments, it's a very different game at 30 million versus 10 million, right? Purchase price, right?
Right.
And so who can raise the capital? It's kind of here.
Yeah.
Where does the capital
Yeah.
come from? That is the piece. That's what we're trying to solve on the show as well for the listeners. They're all either investing in assets, like multifamily or even land, like with you all, or they're they're trying to figure out how to raise the money, right? They either have the capital or they don't, and so. But as you increase in value like that, I know something you love, and we were talking about this before we got started. That is that the data, right, and the finding the asset and finding that deal, right? That's that deal hunt. Is fun. Speak to maybe some things that you're using now that maybe you wouldn't have known to use a year ago or 2 years ago. Now that you've grown, now that you're looking at larger assets, what data are you using now to find that right market and property?
Absolutely. Well, my wife jokes because so my wife works the business with me, Whitney. She's, COO operator, runs, we have 4 companies now, recently started a 4th, but she's run all of them, right? So I'm kind of the visionary. I start everything, get it going, and then she makes sure it actually works, right? But we work the business together, and she kind of laughs at, she says, boy, I miss the days when we just look things up, on Zillow and we bought them sight unseen and we just flipped them and sold them. Now we've got 8 different softwares where we can turn on the wetlands, the FEMA, the 3D, you know what I mean? Transmission lines, utility, all these overlays and layers and stuff. So we disqualify a lot of deals that she says, we probably would have done that if we didn't know. And you know what I mean? We didn't know any different, right? And somebody would have bought it. But yeah, there's a lot more due diligence that goes on as we target higher value properties. We have several, softwares we use. We use something called MapRite that allows us to turn on those layers where we can look at transmission lines, water lines, soils. We can turn on 3D on a property, look at contour lines. It allows us to virtually look at a property. And then we can turn on wetlands and FEMA flood zones and identify some of these things with prior to, and that allows us to essentially like qualify or disqualify properties before we get an agent to go out there and walk the property. Right. So there's a lot of great tools. We use a product called Land Vision to pull, a lot of data. It has zoning layers where we turn on a zoning layer and, if it's multifamily, it lights up one color. If it's single family residential, it lights up another. If it's commercial, and that allows you to prospect, kind of using a map. So all sorts of fun web apps and tools that 10 years ago, even when I started, and you couldn't get single user access to things like this. These were only available for like brokerages or, DR Horton or Toll Brothers, right? So I'm really grateful that that's why when people go, hey, is now a good time to start? I go, oh my goodness, there might be more people doing it, but the tools are incredible. We used to do this stuff with just, Excel sheets and mail merges to Word docs running our campaigns. And now there's softwares for everything. You're kind of spoiled. But yeah, it all starts for me with the data, what I feel and what I coach clients on is kind of market selection. How to learn how to manually select markets. Meaning, when we initially started our first couple of years, I kind of did what I call the copycat method. Whitney, I saw where other investors were, and I kind of reverse engineered what they were doing, and we targeted the same areas and just paid a little more than they were paying. And that got us about 2 years. We did really well for about 2 years, and we worked these counties just, we fished the holes dry. And then the problem was when I went out to find our next market, I didn't know how to use a data-driven approach, to do that. And I stumbled. It took me several months of spending a lot of money on direct mail and just kind of spraying and praying, sending these test campaigns. And then I started to research and learn how you can look at things like days on market, absorption rates, sold to for sale ratios, supply, demand, and inventory, and things like that, where you kind of can solve some of those resale problems ahead of time, and really put yourself in good markets where transactions are occurring. And I felt like once we kind of got that core competency down, that allowed us to build a repeatable business. So I could go into any state and I could immediately start evaluating, what are the top 5 or 10 counties in the state where land is trading at these values.
Can you give us some of those metrics that would help you to narrow down to those top, 4 or 5 counties?
Yeah, for sure. So what one most obvious one is like days on market. It's depending how quick do we want to bring our money back into the business. How many times a year are we trying to cycle our money? If we use title or escrow to close on the buy side, the sell side, you just got to assume there's like 30 days on each bookend. Okay, so when we're looking for, we got to factor that in. So when we look at days on market, we like to look at markets where it's like 180 days or less. So it's usually, 6 months or less. That's kind of a metric. Sold to for sale, what we look for is the market absorbing? Are we at about 1 to 1? We get in these white hot crazy markets, we might have 4 sold for every 1 for sale. And that's good, but it might mean we're in a market where it's going to be tough to get a deal, right? Because everybody's knows their property's, in demand. So we look at sold to for sale and we want to be at about at least 1 to 1 so we know the market's absorbing. And then we look at something called parcels on market ratio, meaning like at a county level, how much of the vacant land is actually on market, right? And we see if we're at like 5% or less of that is inventory, then, that's a sign that we've got a low supply. And then the other things we looked at was high demand, right? So if we kind of marry those two, right? Low supply, high demand, but not too high, right? To where it's crazy, then we know that the land will be, absorbed, right? Then it's just a matter of at the price point we're operating in, right? Is land trading at the price point, our buy and sell box that we're operating in? So we kind of run through those checks. And as soon as we start to say, what are the sold to for sale ratio? What's the days on market? We start with the whole state, and all these counties drop off and our list just shortens and our list shortens and shortens. And then I might say, okay, I don't want to work in this tiny little county where there's only 5,000 parcels in the whole county because I can't work that market for years. So for me, I might even set a minimum of I only want to work in counties with 10,000 or more parcels. So as soon as we introduce all these these filters and we start stacking filters for our requirements, we're able to generally build a pretty short list within a state where it's almost acts like a heat map, for like.
Yeah. So then what's going to be your choice then to reach out to those parcels?
Yeah. So my favorite, and I believe the least volatile and most stable is direct mail is, where we pull using a data source, we pull at the county level. And why we do that is almost all of this owner information and property information. It's because the one thing that unites all of us, regardless of politics, religion, the one thing that unites all of us, if we're property owners, anyway, is we all got to pay property taxes. So that's where we're not on one list or the other. We're all on the same list, right? If you pay property taxes and you own property, there's an assessor tax roll, okay, and that's kind of the container or unit of is at the county level. So when we pull data, you'll hear me talk about county level because with land, that's generally that's where we're getting it is from the assessor at the county. So we're getting the entire county. We can then, segment it based on zip code or whatever, right? Or subdivision or census tract. But kind of at the county level is land investors where we get our data because it all comes from the assessor. And then we choose our outbound marketing channel. When people start, I usually just tell them start with one channel. Until you're good at one, you have no business doing 5. You don't need to be texting and cold calling, right? Sending ringless voicemail if you don't even know how to send direct mail. So I usually start people with direct mail. But you can use any channel you like, if you have familiarity with cold calling or something, they all work.
How do you then say stand out amongst the other land investors, right? I know you've coached so many people to be successful in this space, but then there are obviously competitors as well,
Yeah.
potentially. But how do you stand out amongst them to that seller that may be getting, a number of pieces of direct mail?
Well, what I learned early on was that at first I thought, and I spent a lot of time self-development on I'm from Montana and I kind of got these Midwestern values, and I'm just absolutely terrible at sales, right? And negotiation, and nothing came natural, So I'm trying all this self-development, reading all these books about seller negotiation and all these things. And what I realize is you're not going to talk people, out of their property. Okay. If once you identify, just building some rapport and identifying like, why are they open and why are they even entertaining your offer, right? What did they originally intend to do with the property? So a little bit of discovery. A lot of people, and I did this early on, they focus on the property, the value, the dollars. And I kind of like go like, why do you want to sell it now? And then sometimes you even go, why don't you use an agent? Right? Like, this is a beautiful property and you want closer to full market value. Why don't you just use an agent? And then they'll say, oh, I had a bad experience. Like, we listed with an agent, they listed too high, it sat for a year. So you'll identify, I'm always like playing discovery. I'm identifying their biases along the way and discovering things, right, about the property. But ultimately, what I've found, Whitney, that separates everybody is it's not the negotiation, it's the follow-up. And most investors make one, maybe two efforts. So they'll
As far as
send,
that direct mail, you mean?
yeah, they'll send out that lead generation piece. The lead comes back. Let's say somebody's new. They see that voicemail come in and they're working a job and they go, oh, I can't get to that till lunch. And then lunch is busy and they can't get to it at lunch. They go, I'll get to it after work. And then they got to go home, dinner with the family. And they go, well, now it's tomorrow. And they haven't called the lead back. And I've called the lead back in 7 minutes. Right. So the difference we've noticed is truthfully follow up. Most people make one, maybe two attempts at following back up, and then the lead goes stale, the lead goes dead. So it's usually not even about like me having a better offer than you. It's about I'm going to reach out, 4, 7 times in the first week if I haven't heard back from them. And the majority of the industry is just terrible at follow up. People just default to spending more money on more marketing versus continuing to follow up with the leads they've already paid for and have. So we've felt like that's always been our difference, is just connecting at a human level, building rapport, understanding. And if we can't buy the property and they want full market value, I might say, hey, you know what? I'm an investor. I've got to insulate myself from risk. I'm not going to waste your time. We couldn't make something work, but I've got a great agent, right? I've got a great agent in this area. Can I connect you? You're interested in selling, you want to get full market value. I'm confident he can do that for you. No kickback, no referral fee, just connect him, right? And that shows a lot of goodwill to the agents that I work with, and it solves the seller's problem, right? So that's where we try to do things a little bit different, right? Is we try to solve the problem, we connect at a human level, and we follow up. And most people just, approach it very transactional, and then are kind of on to the next one.
Yeah, no, that makes a ton of sense. That applies in our business in such a big way, following up with investors, right? And we're often so focused on the lead generation piece, finding new investors that want to invest with us, but we forget, hey, we've got hundreds, if not thousands, of people already on our list that have already signed up and said, hey, we're interested.
Right.
But we don't spend much.
Who you got. And then also shifting from, and this is something my wife actually, it was kind of a blind spot I had, and she helped me with. My wife's background is she worked in reverse mortgages. So she kind of helped this older demographic, right? And these individuals, they want to be heard out. They want to talk, right? They want to talk and they want you to listen, and you have to have empathy and you have to truly care. And she kind of helped me with that because I was very much like, hey, let's scale this business. Here's the dollars and cents, here's the transactions. And like she kind of helped me with the transitioning from seeing people as leads to these aren't leads, these are people. These are people that deserve phone calls back and as quickly as possible. And you need to show them that courtesy. So that was good for me because I even calling them leads, right? It was like, they're not leads, they're humans, they're people, right? Same thing. So when somebody comes in, it's like, ooh, not a new lead. It's like, oh, Whitney or Travis, right? Just submitted something on my site. I need to get a hold of Whitney or Travis, not like just a new number, a new lead. And that was something that wasn't inherent for me, but kind of moving from transactional to relational really, really helped us increase our conversion rate.
I want to go one step before this and say, just to give the listeners an idea, how many mailers, are most people sending? Are you sending, say, on a monthly basis? And then what kind of response, is typical, from that many mailers?
Yeah, we find just for easy math, bank on about a 1% response rate. Depending how competitive markets you're in, it might go up, a 1/4%, it might go down 1/4%, a little bit below. But just for easy math, I say about 1% of people respond. That's why when we tell people what they do, they go, well, geez, who's lining up to sell their land for half price, right? And I go, well, first off, only 1% even acknowledge or respond to the, you know what I mean, to what we send. And then we might talk to 30 or 35 or 40 people. We might get 39 no's and one yes, right? Of that 1%. So that's generally what I tell people is kind of the cheaper the properties you target, usually the higher response you'll get and the higher conversion rate you'll have, right? As you target higher value properties, you'll start to see response rates go lower. People will want more, right? And your conversion rate will suffer, right? It'll take more leads, more humans to a deal than it will with the smaller deals. But I generally say kind of build your budget on about a 1% response rate. And that allows you to kind of identify just what's your minimum deal size? What are you trying to make per deal? Some people build their businesses on like $10,000 a deal. They'll do 30 to 50 deals a year. Other people say, hey, I just want to make, 50,000 a deal and do, 3 or 4 deals a year. So it's really kind of starting with your financial goal and then working with the backwards math and go, well, the sometimes when I'm coaching, somebody will fill out an onboarding form and I'll say, well, what's your goal? And they'll say $1 million. And I'll say, what's your monthly marketing budget? And they'll say $1,000. And I go, okay, there's a big correlation here, right? There's a correlation to marketing spend, right? And deal flow. So you can't be a disconnect there. But if you're willing to spend on marketing, you can bank on about a 1% response rate.
That's good to know. Just set that expectation, right? How many times are you going to mail, say, the same people, right? The same landowners, before you move on or put that marketing spend somewhere else?
I think the best answer is until, right? Like until, meaning so I'll give an example. The first county we operated in was in northern Arizona, a county called Coconino County. It's where Flagstaff, Arizona is located. A lot of people know it for the ski resort, right? The college and ski resort. But we started there 10 years ago and we're still actively investing there. So what you start to realize is that it's not even how many times you market, it's timing. It's like when the letter hits, what's going on in their life. Is the granddaughter going to college now and wasn't 5 years ago when you mailed them or 2 years ago, right? Like it's almost always an event or something that triggers a change. I had a coaching client where my wife and I had bought 30 or 40 properties from this individual guy. He owned 130 properties, okay, when we first contacted him. And we did not have the means to take them all down, even if they were available. And he only gave us an option on about 10 or 20. And we bought them from him. And then a year later, we bought some more. And then another year later, some more were available. I tell you that story because then I had a coaching student who was marketing and mailing in this same county that I was investing in. And I'll often put clients, like students, in my markets because I have agents, I have surveyors, I have title companies, like I have, this teams. So I don't view it as competition, right? And he was able to connect with the same seller, and he brings the deal to me and says, hey, this guy has 30 properties available. And my wife and I are laughing. And I said, well, how come he didn't sell them to us? We brought from him 3 or 4 times. And here a student of mine was able to get a portfolio of 30 deals, right? And they just weren't available at the time. But now this gentleman wanted to do a 1031. He wanted to take from the land and put it into rental houses. But when I had conversed with him 2 or 3 years earlier, it was like, these are off limits. I'll hold these forever. They're going to the grandkids. So it's very much a timing, right? It's very much a timing thing. And events are always occurring, right, in people's lives. So we kind of like to canvas, and we kind of like to get into markets I call like marathon markets. Like we're in 4 counties here in Arizona, and two of them we've been in 10 years. The other two we've been in, probably 7 years.
Wow. And mailing a lot of the same people most of that time, or?
Over and over and over again. Yep. Yeah, a lot of the same people.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.